markets from David Alao. He's an analyst with Stanbic IBCT Asset Management. David, I'm sure you're doing great this morning. Let's get straight into it. Like we said, a sudden end to the bullish run on the market. Profit taking is what analysts are saying is a reason for this. What is your take on what's happening with our markets today?
Well, I also believe that due to profit taking, yet quarter today we've seen a strong bullish run. We've seen the NSE ASI do well over 11%, and we do believe that yes, there are some news affecting the market at the moment, including issues regarding the NSE, the SEC. However, we think the real issue really is profit taking. In the past, we've seen when news hits the wires, eventually it filters into the market. So you have investors who are saying, look, I'm going to take some of the profit now, and if the market retraces backwards, all well and good. But we strongly believe that it's as a result of profit taking, not as a result of SEC issues.
Okay, so strongly believe it's as a result of profit taking. But tell me, David, what is your outlook for the market, of course, today and during the course of next week? Do you think we're going to see a similar situation with investors sort of taking profits, or do you see the market picking up again?
Our long-term view of the market is, well, given fundamentals such as cheap ratios, so you have cheap book levels and cheap price to earnings ratios. I believe that the market is poised for growth in the long run. However, you do have issues and overhangs such as the European crisis that are affecting our markets as well. So in the immediate run, in the immediate term, I believe that you should see a bit of a pullback. In the medium term, we think the market should rally again. We are seeing increased flows by foreign portfolio managers into this market, which is also a good thing. Therefore, we believe that in the long run, investors who stay with the market will be better off.
And I'm sure it's a similar situation in the fixed income markets. Tell me more about what's happening there. We do know there was an auction, a federal government auction on Wednesday. What were the results of that auction, David? And of course, with the current economic settings, what did you see in those results, and what were the drivers of these results?
Right. At the auction, the three bonds were issued: the 5-year, the 7-year, and the 10-year. The 5-year printed at 16.19. The 7-year closed at 16.599, which was rather surprising. And the 10-year closed at 16.29. From our view, what we've seen driving this market, we've seen well, let me take you back to prior to this auction. We had a sell-off in the market where we had foreigners leave the market as a result of fears of a devaluation in the naira. That fear was brought on by a decline in the global outlook for growth, and a decline in commodity prices, hence a decline in crude oil prices, thus affecting Nigeria and the ability of the CBN to defend the naira should investors want to pull out their funds. So you had investors leaving droves. Now we're seeing these guys come back into the market because oil prices have sort of firmed up, i.e. you have ongoing issues in Syria, and you also have the political issues in Iran. So these factors support a firmer oil prices above $80 a barrel. For that reason, we do see yields in this market remaining between 14 and 16%. However, some of the key drivers of what we saw at the auction include IFRS adoption by the banks, as well as the bond switching calendar. If you remember, the DMO came out with a bond switching calendar to switch about 540 billion naira worth of bonds that will mature next year. a lot of the players in the market felt that the issuance of these bonds, or the switching of these bonds, would increase supply, hence increase bond yields. So they decided, okay, let's leave this market and come back later on. However, we haven't seen the bond switching actually take off just yet, and we're seeing investors in the market coming to take advantage of the higher yields. With IFRS, we're seeing a lot more asset allocation towards treasury bills as opposed to bonds, particularly with the banks. So we're seeing banks now doing 70% of their trading in treasury bills and just slightly over 20% in bonds. With that, they're also in bonds, they're also playing at the short end of the curve. So what we're seeing is not a lot of demand at the medium end, because at the long end you have the pension funds largely playing there. So at the auction you had 25 billion issued across board, but at the short end we had a supply or a demand of about 41 billion. Like a 2-time subscription. At the long end, we also had a 2-time subscription. But at the medium end, the 7-year, we had 25 billion offered, and just 27 billion was bidded for. So obviously, you had the yields closing higher there.
David, very quickly, with this situation that we're seeing at the last auction, how should investors position their fixed income portfolios going forward?
Right, going into the bond auction, the 10-year looked like the cheapest bond on the market, but now with the 7-year printing higher than the 10-year, the 7-year seems like the cheapest bond on the market. We do believe that investors should be buying the 7-year and the 10-year bonds. We do believe that going forward in the medium term, we should see a decline in yields driven by a decline in inflation. We do believe that investors who position themselves at those tenors would benefit going forward.